Hi everyone, Josh and Donato here with DXE Properties. What we wanted to do today was have a little bit of a discussion about returns across different deal profiles. So we have a couple examples to talk through and debate amongst ourselves, and we're excited to go ahead and jump right in. So on this first page, we have a pretty simple example. Take the same deal in the same market at the same time. You have a new development project, a value add deal, and a stable deal. All three of them have the same return of a 16 IRR. And the simple question would be, which deal are you going to be attracted to? Which one would you do?
So I think this one's pretty easy, Josh. The same market, same location, same building. You would obviously pick the stable deal, right? Because you already have a proven track record of how this property's been operating. If you get, the proper due diligence information, which you should, of the previous financials, tax returns, etc. So you have a pretty confident idea of what the property has been doing, and as long as you believe you can manage the property the same way, you should be pretty confident that you could get at or near those returns in the future.
I agree. I mean, when it comes to a value add deal or new development deal, why take on the risks of some of the unknowns if you can step into something that's performing with the same return? So again, I think this question's pretty easy, and anyone watching in probably thinks the same thing. It's sort of a no-brainer. Where I think it becomes debatable is when you have returns that are a little bit more representative of the investment profile. So in this case, you have a new development deal with an IRR of 25, the value add deal with more of a 16, and then a stable deal that's a 13. And then I would pose the same question to you, Donato, which deal are you attracted to?
So this becomes more interesting. And I'm going to throw a little bit of a twist into this answer. It partly depends on where we are in the market cycle. So if we're at the end of the market cycle, I'm going to stay away from this new development deal, even though it's promising outsized returns, because my confidence that we're going to be able to hit those returns at an end of a market cycle when there's a ton of new product probably in the market already, rents have probably topped out, and employment has probably topped out for that cycle, is, adding a lot of risk. However, if we're at the beginning or middle of a market cycle, I'm all about this new development deal. And it really comes down to why am I so excited for new development over these other options? It's because of the outsized return that I'm able to get. And this outsized return really represents something that I'm not able to get in other investments, aka the stock market or the bond market or even private business investments. So I'm willing to take that risk, especially since we have a lot of development experience in-house to get that outsized return. What about you?
My answer probably shows that I'm really a 6-year-old in a 30-year-old's body. That I'm really attracted to the more stable performing deals. I think that what's really important to understand as an investor is, what's the purpose of your investment? Are you looking for something that's just very tax efficient, which you're not going to necessarily see in new development, regardless of what the returns may be? Are you looking for something that's a little bit more cash flow driven to help maybe supplement retirement or coupon clip for you? For me, I just think from the approach of something that's stable, consistent there with less variables is always going to resonate to me in any stage in the market cycle. I think that a value add deal, a stable deal, right story, right opportunity is always going to exist, and that cash flow is always going to be your safety net. To the point that you made, is there a point in the cycle that you might be hesitant to buy that stable deal?
I wouldn't say I'd be hesitant to buy the stable deal. What I would say is that I'd be more likely to go new development again at the beginning of the cycle, whereas as the cycle moves on, I'm more moving towards the right side of the screen, towards value add and stable, because I want that cushion of the in-place cash flow for if the market corrects, if the market slows down, or if we enter into a recession. We know that these properties are already producing cash flow and that we could weather this upcoming storm. We don't have to worry about bringing a new product online in a bad market.
I think that's fair. I don't think there's a right answer, but I think that what's important is that whoever is looking at any project really understands the risks and rewards and is mindful of a lot of the other variables that we're not going to cover in this discussion, which is market, team, some of the assumptions actually being made. But what I would say is this is one of a handful of other little quick discussions that we're going to put together that touch in on different points and components when underwriting, assessing, and just debating different investments. So if you haven't already, please do subscribe to our YouTube channel, and you can also sign up for our newsletter at dxeproperties.com. Thank you.
Thanks for watching.